Today, trading is rather lackadaisical as traders are anticipating the FOMC meeting. The Fed's key rate decision will have a tremendous impact on the markets as well as the central banks worldwide. The S&P 500 slid into a bear market because of rumors about a more aggressive rate hike. Given the bad start of the week, stock indexes are still lacking positive drivers. However, they closed mixed yesterday, hovering at the levels of several tenths of a percent. In today's Asian session, US stock futures even showed a slight increase. Meanwhile, Japanese and Australian stocks are declining in anticipation of the Fed's key rate decision. According to Fed Watch CME Group, there is a 95% probability that the Fed will raise the benchmark rate by 75 basis points. If so, it will be the biggest rate hike since 1994. Our analysts believe that the Fed will hike the cash rate by 0.50 points. There are several reasons for it. To start with, the regulator confirmed earlier a 50 basis point increase. Back then, policymakers were also aware that high inflation would persist and they should brace for a long fight. They were also expecting the CPI figure for May to reach new all-time highs. Apart from that, the Fed is still nourishing hopes for a soft landing, even though the chances are extremely low. It still has room for maneuver thanks to a resilient economy and a strong labor market. Last but not least, any sudden changes in the Fed's plans may adversely affect market worldwide. As a result, it may trigger recession not only in the United States, but also in the other countries. Investors are closely following the Fed's comments, looking for clues in every phase. For this reason, the regulator will hardly become even more hawkish, as it may lead to unpleasant consequences. At any rate, we will find out the result of the meeting in just a few hours. Inflation has not peaked yet. It's also still unclear at which levels inflation could stop its rise. Hence, analysts advise investors to revise their portfolios in favor of real and safe haven assets. They also recommend reducing the duration. The duration matrix is the percentage change in the share price and its yield to maturity. It will help them make the payback period shorter as well as lower the risks. The king of the safe haven assets is the US dollar. Demand for the greenback usually soars amid the risk of sentiment. In the Asian session, it jumped to a 20-year high. The US dollar index was consolidating in the range of 104.71 and 105.39. At the time of making this video, it was trading at 104.86, slightly moving down. Over the past few months, the US currency has taken the lead versus its main rivals, as the Fed has been more hawkish than other central banks. Now, its counterparts have weakened even more for various reasons, so that analysts call the US dollar the best among the worst. The yen incurred the biggest losses versus the US dollar, while the majority of central banks raise the key rate. The Bank of Japan sticks to its dovish stance. It also keeps the yield of Japanese government bonds near the zero level, pushing the yen significantly lower. At the beginning of the trading on a Wednesday, the yen fell to a 24-year low of 135.58. After that, it managed to rise slightly amid the consolidation of the US dollar. At the time of preparing material for this video, it was trading at 134.55. The pair was moving in the upward channel of 134.39 and 135.60. On a Monday, when the dollar-yen pair sank to the lowest level since 1998, the Minister of Finance and the Bank of Japan governor provided their comments on the situation. Both Shunichi Suzuki and Hirohiko Kuroda stressed that the yen's recent sharp declines are negative for Japan's economy and undesirable. They expressed readiness to respond appropriately if needed. Will the regulator move on from words to deeds? The low yield in yen also forces Japanese businesses to increase the cost of energy commodities. As a reminder, energy prices are growing constantly in Japan. The Aussie, on the contrary, is usually up when energy prices surged. However, this rule does not work now, ahead of the FOMC meeting. All other drivers have also faded. Being a barometer of a risk appetite, the Aussie is diving down now. In addition, China's economy is weakening by lockdowns. The AUD USD pair was trading in the bearish channel of 0.6865 and 0.6938. At the time of preparing material for this video, the pair has already reached 0.6933. Over the past 3 months, the Aussie has decreased by 7.9%. It means that this quarter may become the worst since the first 3 months of 2020, when the pandemic broke out. And that's all for now. We keep close tabs on the market developments. Our analysts would be happy to answer your questions. If you have any, please leave them down below. And InstaForex TV team is already making a new video release for you. See you soon.